Good afternoon, ladies and gentlemen, and welcome to Unlock the Stock with Growthpoint. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and to get to know the businesses and their companies a little bit better. This event is sponsored by Keyter Insurance and FX, an FX intermediary and insurance brokerage for niche markets, which include bloodstock, sport horse, and game insurance, as well as household, vehicle, and commercial insurance. Whether in the insurance business or FX, Keyter are involved in matters that affect people's lives. Keyter Insurance and FX, in your corner. You can visit their website at www.keyter.co.za to meet the team and to read more about their service offering. This platform would not be possible without our technology partner, Lumi Global. Their website is lumiglobal.com, and you can visit it to find out more about their various integrated online AGM and investor presentation solutions. Our host today will be the finance ghost and Mark Tobin from Coffee Microcaps, and they'll be facilitating the Q&A session at the end of the presentation. We would like to welcome Growthpoint, represented by the CEO, Estienne de Klerk, who will take us through the presentation, and Lauren Turner, the Head of Investor Relations. Before we commence, there are a couple of housekeeping rules. Growthpoint will do a short presentation. Please note that you can post your questions in the chat function at the bottom of your screen. The session is being recorded and will be available on the Keyter Investor Solutions YouTube page, so be sure to subscribe to the channel. During the Q&A session, you will see an email address, and if you want to be put onto the Growthpoint database, you can just copy that email address and reach out to them. I'm now going to hand over to Estienne de Klerk. So Estienne, can you share your screen with us and take us through the presentation?
G'day everybody. Thanks for joining in on the call. I'm going to give you sort of a brief overview of Growthpoint, the company, as well as a overview of some of our most recent results, which was our year-end ended to the 30th of June. So in summary, Growthpoint today is the largest REIT in South Africa. It's the 38th largest company on the top 40 on the JSE. It has a gross market capitalization of about 42 billion rand. The share price is trading at bargain basement prices at the moment at just under $12, so that market cap's come down a little to about 40. It is the most liquid and tradable way to own real estate in our country, and we pretty much slot into most of the indexes, whether it's Responsible Index, the FTSE for Good, and obviously the FTSE EPRA and REIT emerging market indexes, which all add to that liquidity and tradability of the stock. In terms of the investment proposition, basically we have the best quality portfolio available. It's a diversified portfolio. We provide a reasonably stable and dividend income yield of circa 11 to 12% at the moment, depending on the share price. We're trading at circa 45 to 50% discount to NAV, which is our latest NAV of 2158. We are diversified across various international geographies with various income streams, which we'll dive into through this presentation. We have a dynamic and proven management team that has got a 20-year track record. We do practice the best governance. We have transparent reporting. We have level 1B E-contributor, and we've got a very attractive ESG investment proposition and investment grade AAA SA domestic debt rating. If you look at the composition of the portfolio, more than 43% by value is now from offshore, and from an earnings perspective, just under a third of our earnings actually come from Australia, the other parts of Africa, the Eastern European and the UK business. So pretty diversified geographically. In terms of the business itself, in terms of the results for the period, we had a distributable earnings bottom line of 5.3 billion. So that is effectively the income that's available for distribution. And because we are a REIT, we are obliged to distribute at least 75% of our income. So if you think about the business, it earns income through rental and fees and profits. It then pays expenses. And it then, on a 6 monthly basis, we distribute predominantly all our profits to you, the shareholders, ultimately. Now, for the year, we distributed 155 points, or the available income was 155.6 cents, of which we distributed 128.4 cents, which was 8.4% up on the prior year. Obviously, the prior year was quite negatively impacted by COVID. That gives you roughly about an 82.5% payout ratio, and the balance of that income is retained in the business for the benefit of all the shareholders and to ensure that we have capital available for maintenance and other capital expenses that we deem fit. The portfolio has a value of over 160 billion today. We have debt on balance sheet on a consolidated basis of 37.9%, which is very conservatively positioned, and our NAV, as stated earlier, is 21.58, so 21 rand 58 cents, which is a 6.7% increase. So the stock is trading at quite a discount to the market. If we go and look at the South African portfolio, just some salient features there. I think we pretty much through COVID now. I mean, the total impact for the year was a mere 17 odd million in terms of discounts granted, which is significantly improved from the prior year. We've also seen, that effectively we've recovered most of our deferred rentals. The total impact of COVID on the company was circa about 800 million, of which pretty much 492 was discounts granted mainly to the retail sector of the business. But as I've stated, we're pretty much through that and things are on the up now. Our vacancies have come down quite significantly to around 10.3%. To give you an idea of the scale of the business, I mean, it's over 5.5 million square meters of property just in the South African context, and we relet just under 1.4 million square meters in the year. So you can think operationally that is quite a significant process within the operating business. Rentals currently remain slightly under pressure when we renew, and each one of the sectors, and we'll run through them, have different dynamics. We are retaining significantly more clients at the moment in terms of our renewal success rate, and our arrears have come down quite significantly. Now, before COVID, to give you an idea, that number, which is now at 195 in terms of sort of ongoing arrears, was under 100 million. So it is moving in the right direction, but probably has a little bit of still some legs to go. Our expense ratio is up marginally, and that's really an impact of, let's say, the additional vacancies we have in the portfolio, as well as the fundamental escalations in, for instance, rates and taxes, etc., and the marginal reduction in some of the rental lines. In terms of the portfolio, that was written down by 1.7%. The bulk of that really relates to the write-down of 1.5% in our office portfolio. And then we've been very active in trading some of our non-strategic assets. We've sold over 2.1 billion in the year. We continue to develop and invest in the portfolio, and as such, have spent 1.1 billion, and we still have further commitments of over 650 million. So actively investing still in the South African business and making making new acquisitions. So in our Growthpoint Investment Partners business, we have acquired 2.1 billion of student accommodation in a fund. So investors can invest in Growthpoint per se. They get some exposure to the fund, but they also can go directly into what is a unlisted REIT per se. If we look at the South African portfolio, very diversified. Our retail and office is pretty much the same size, about 38 and 35 respectively. And then 18% of the portfolio today is industrial. And then the balance is effectively our student accommodation and our healthcare portfolio. Also well diversified within the South African sort of landscape geographically. So this excludes the V&A, just for clarity. And by region, you can see predominantly still the major investment is in Gauteng, just under half. We've got about a quarter in the Western Cape, and then the balance is spread over the Pretoria, the Eastern Cape, and the Northwest. If we go and look at each one of the sectors now, so just to give you an idea of the scale, the industrial portfolio comprises 187 properties. It's over 2 million, just under 2.1 million square meters, and it's valued at 12.1 billion. Now, of the three sectors, this has recovered the best in post-COVID. So, vacancies have contracted materially from 9.4 to 5.7, and in fact it is well on its way below 5%. So the industrial sector really going strong, specifically in the Western Cape and KwaZulu-Natal, and that theme of the Western Cape and KwaZulu-Natal rings true right across the portfolio. So it does seem that the Gauteng economy is lagging, unfortunately, relative to the rest of the country. Our renewal success rate is significantly better, and the negative reversions are contracting quite materially. And my view would be within the next 6 to 12 months, I think that will be eliminated entirely. Escalations are somewhat under pressure, but given the increases in the inflation rate at the moment, I think that puts us in a little bit of a better position to negotiate higher escalation rates with our tenants. And as earlier mentioned, certainly the arrears on material decline. In terms of the like-for-like growth in rental, so the portfolio, the same properties compared last year to this year, you can see that nominally the portfolio's income is growing, and the valuations as a result have also grown marginally about 1.8%. We also have taken the opportunity to sell into a market where industrial, the theme is very popular, and certainly in the private client investor market, as well as owner tenanted sort of investors have been buying up quite a few properties. You can see there 22 transactions made up just under 700 million rand worth of value that we've traded in the period. Looking at the retail portfolio, we've got about 42 properties. That's just under 1.3 million square meters worth just under 25 billion rand. The vacancies have also contracted. It's about 5.5%. Certainly there seems to be demand from our national retailers, which really make up the bulk of the tenant base in the portfolio. The property profile is predominantly regional shopping centers and large shopping centers. We do have one or two shopping centers that have a couple of problems at the moment, where there's let's say significant competition that's come on with new developments close by, but we are actively working on those, and because there's demand, we will be able to repurpose those shopping centers, and I think you'll find that number over time should be improving. In this space, we've seen the success rate improve, and we've also seen the negative reversions. And I must admit, the retailers' sterling performances of late have really come at the expense of their landlords, where they've been pretty aggressive on the rental side. But because the trading densities in the shopping centers are improving, we've seen an 8.6% improvement in the trade, so the turnover per square meter. And I think what will happen is within the next 12 to 18 months, we should start seeing those negative negative reversions also maybe dissipating and maybe going in a positive territory. That has resulted in flat valuations on the portfolio, and we have also managed to trade 4 properties there, just over 600 odd million, and those transactions were actually done at a profit to what was on our book value. So certainly underpins the value as being quite conservative. The toughest of the 3 sectors remains the office sector. And, you know, the office sector, unfortunately, is the sector that's probably most correlated to economic activity and the strength in the South African economy. And we have seen specifically in Gauteng that the market has been pretty weak. Actually, in Durban, our vacancy levels are below 7% now. In Cape Town, they will be moving below 13% pretty soon. And the markets there are significantly stronger than what we're seeing here. And in Sandton specifically, which is very focused on the sort of financial services and the services, businesses like attorneys and professional services, we've seen that those markets have been pretty soft, and Sandton is pretty oversupplied. So it's going to take a little while to eradicate that, but a lot of this pain is already in the base effectively, and you know, hopefully we'll start seeing some growth from here. As a result, the like-for-like growth in the portfolio, specifically the office portfolio, was negative, and we are seeing that, you know, the work from home dynamic is probably not proving to be that sustainable. We're seeing a lot of smaller tenants coming back into the market. In fact, ironically, load shedding has really probably helped us a little bit in this space, and that many people don't have electricity backup at home, and as such prefer to work from the office where there's comfort and air conditioning. And you know, the only thing that's been working against that return to work has really been the higher fuel prices in the market, and that probably will hopefully dissipate as the fuel prices start coming down. In fact, I understand they're coming down over rand just this week. Valuations as a result have remained under pressure, but we've actively been able to trade out some non-strategic assets and continually improving this portfolio. If you look at the total makeup at the V&A, so I'm moving on to the V&A. So the V&A, we own 50% of the Victoria and Alfred Waterfront with the government employees pension fund. As you can see, the V&A in itself is very diversified, with the most of its value in retail and also the most of the income coming from the retail portfolio, followed by office, and then the marine and industrial is pretty active in that market, with also hotel and residential making up a big component of the income. The highlights at the V&A, I mean, I think, you know, the profit literally halved at the V&A over COVID. I mean, it is a very unique asset. It's one property. It's now over just under 500,000 square meters of bulk developed. Our half is worth 9 billion rand, and we've seen the profit literally half but come back, and I think this year we'll see the profit basically returning pretty close to COVID, or maybe even exceeding COVID levels. We've seen the return of international tourists, and hopefully we'll have a bumper holiday season coming in this period from September through to March next year. On the financial metrics side, I mean, you know, the income is over 52% higher, and largely due to the material decrease in the COVID relief that we've had to offer tenants there. And the operating profit is also materially higher compared to prior year, and our numbers of footfall and visitor numbers have also increased materially at the V&A. Retail, in fact, as we stand in the current quarter, you know, the trade in that shopping center is actually exceeding the last normal, which was like pre-COVID. Vacancies are minimal at 0.8%. There are some rentals that have reverted to the extent of about 10% but you can see the fundamentals are significantly stronger, and the rental levels that we achieve at the V&A are probably higher than any other shopping center in the country. On the marine side, we've seen strong continued trade in the fishing industry, also the casual berthing of the super yachts, as well as the yacht building industry. We've seen strong growth in that space, as globally that market has actually improved post-COVID. And what we are hoping to see is that the cruise terminal, which is the international shipping liners going through the V&A, will also start operating in this month, and that really gongs in the start of the holiday season. Office, here, bizarrely, the portfolio is full as well. 1.8% vacancy, which is really just churn. We actually even building additional office space in the V&A, which is quite unique. I think office demand has driven development to pretty much naught across the country, other than at the V&A and one or two nodes that there's still reasonable demand. And then on the hotel side, we've seen hotel occupancies up 81% from last, or 81% of last normal levels. So certainly that is a marked improvement. And this sector was very, very negatively impacted by the lack of international tourists. And even the residential, we've seen vacancies come down pretty much across Cape Town, but specifically in the V&A. When we look at our international investments, so to give you an idea, GOZ today is probably like the 10th largest REIT in Australia. It comprises 58 odd properties. It's 1 million odd square meters, 58 billion rand, or just over $5 billion. We've seen very, very strong growth in the investments there. I mean, from an investment perspective, we invested around about just under 10 billion rand, and it's worth just under 19 billion rand. So arguably the best investment Growthpoint's ever made. The market has been very, very strong funds from operations growth, so equivalent of distributable earnings at 7.8 odd percent, and the distributions there have also grown at 4 odd percent. So strong growth underlying the fundamentals there. So the core investment is still very strategic to us. The balance sheet is also very conservatively geared at 34 odd percent. We have been making acquisitions in that market, and to give you an idea, in the past quarter, we've actually also been buying back shares, because the share price NAV is at 456, and the share price has been hovering around the 340 odd mark. So from the best investment we have been able to make in Australia is really buying back our own shares there. So it's a pretty strong market for Growthpoint. If you look at the portfolio, the like-for-like growth in valuations has been 7.9%. 2/3 of the portfolio is office, and 1/3 is industrial. The portfolio is fully let. We've seen a strong average improvement in the weighted average cap rate, so that's at 5 odd percent. It's got a very long weighted average lease length, which is the WALE, if you'd like. The weighted average lease expiry is 6.3 odd years, and a very high tenant retention rate with lots of letting in that market. As earlier mentioned, the portfolio is metropolitan office and industrial, which happen to have been the best two performing sectors in that market, and pretty widely spread right across Australia, specifically targeting the East Coast, Brisbane, Sydney, and Adelaide. Our latest and smallest investment is Capital Regional, which is a small REIT in the UK. The value of the portfolio is about 8.5 billion rand. We own 60 odd percent of the company. We made this investment in literally December 19, 3 months before COVID. So not the greatest timing, unfortunately. And this company was particularly negatively impacted by COVID. But what we have done subsequently is we've improved the balance sheet significantly. So the debt has come down from 72% LTV to 40-odd%. We've restructuring the balance sheet. We've sold off one of the assets. We're busy working through some of the issues in some of these assets, but the profile of the assets are basically 6 shopping centers, needs-based shopping centers, which is sort of the big butcher, the baker, the candlestick maker in the end of the day. And as a result, it's a very sustainable earnings profile with very, very high quality tenants. Global Worth is our investment in Eastern Europe, and this investment has performed reasonably well for us. We own 29% of the company, which has a market value at the moment of 6-odd billion. As you can see, the share price there has come under pressure, but only 10% of this company's shares trade. So the liquidity in the stock is very, very minimal. And as such, you know, you can't really read much into that valuation, unfortunately. The balance sheet of this company also was very conservatively leveraged with a huge amount of cash on the balance sheet, which caused the income statement to contract somewhat, in that you were paying for the cash in the account because you didn't earn interest on this cash as well as the debt. So the reality is the balance sheet is quite conservatively geared, and the business is pretty well positioned for growth going forward. We continue to invest in that market, developing and acquiring. The market is strong, very strong business process outsourcing market. And as you can see, the portfolio is valued at 3.2 billion euros today and consists of just short of 1.4 million square meters. If we look at our fund management business, so we have effectively 3 investment products in the fund management business. The investment business is called Growthpoint Investment Partners. So the first fund that we have is our healthcare fund, consisting of 7 properties worth about 3.4 billion rand. And this fund has performed very, very strongly. Distribution grew last year at about 11.8%. This year at 7.5%. So very uncorrelated from the other commercial property sectors. It is an unlisted REIT and effectively has very large institutional investors locally and internationally that have invested into this REIT. Has also a very nice pipeline of opportunity. Then Lango is our company that invests north of our South African borders into Africa. This business has a valuation of over 800 million today, rand in terms of our investment. The total valuation of the portfolio is over $600 million. We've invested in areas like Ghana, Nigeria, and Zambia, as well as a little bit of land in Angola. And the portfolio actually has performed pretty well. The company is currently raising more capital and will invest that into Nairobi in Kenya. So that business is also performing very, very well for us. The last fund, effectively, and the newest one, is then the student accommodation fund, which I alluded to earlier. This business has effectively got a portfolio worth 2.2 billion. We own 240 million's worth, or 16-odd% of the business, and we're targeting to grow this fund to over 12 billion over time. So if we look at our strategy in action, I mean, we remain focused on the strength of the balance sheet, ensuring that we're conservatively geared, that we have enough cash on balance sheet, and as such, you know, we're not paying out 100% of our payout ratio at this stage, and probably unlikely to in the near future. But investors can expect a solid dividend, which will, you know, probably range between 80 to 90-odd% of total distributable earnings. And then if we look at the strategy in action, you know, we continue to look to grow our offshore component, continue to diversify the business, and incrementally grow in our investments in the business, and, you know, get a good exposure to that hard currency dividend income, which is now at about 1.5 billion. Then on the South African side, we continue to optimize our portfolio. We continue to invest in the portfolio, but the focus is on improving the portfolio across the board, and continually focusing on the the better performing nodes and the better performing sectors. On the investment partners business, there we've now got 15.6 billion of assets under management. The fees for this business was 67 odd million rand, so it's still early days. We're looking to double the assets under management in this business over the next few years, and that's quite an ambitious task. But we'll obviously add quite a lot of sticky income to the business. And our trading and development business, the focus has always been of adding between about 100 to 200 million annually. Obviously, this income is pretty lumpy and quite difficult to time, but consistently we've been able to sort of meet that objective. Looking forward, I mean, the portfolio is diversified. We've got a strong balance sheet, stable hard currency dividend income streams that really position us pretty defensively for what is still a very difficult period going into interest rates and higher inflationary environment. So, given this high level of uncertainty, I think we really expect the distributions or the distribution growth probably to be muted, given the higher rising interest rates and higher inflation. If you look at the distribution profile, it just gives you briefly a feel of how those distributions have performed over the last few years. And you can see we've still got a little bit of recovery to make from prior COVID periods where, we paid out 218 cents. Now, obviously the comparable be the 155 to that 218. So, we've got a bit of work to get back to those levels, but we believe there's very nice value to be had. I mean, if you consider, I think cash deposit at the moment, you're probably getting 6.5% at best. So if you can double that with a growing prospect, that's probably not the most unattractive alternative. And I think that covers Mark and Vanessa, the presentation for today as an intro.
Thank you so much, Estienne. That was a comprehensive presentation. We're going to go into the Q&A session now. And as a reminder, you can post your questions into the chat box, which is at the bottom of your screen. And for this part of the event, I'm going to hand over to the finance ghost and to Mark. So over to you guys.
Thanks, Vanessa, and thanks, Estienne, for the very comprehensive presentation. A quick question from me. Is there any plans to further enhance the geographic spread, into North America or developed Asia or, other parts of Europe, let's say the Nordics or, France and Germany, maybe Benelux countries? Or is that geographic mix, are you kind of happy with what you've got there now?
Yeah, so Mark, I think at the moment, I think we obviously in more of a consolidation sort of framework. I mean, Australia for us remains a key investment destination, and the idea is to grow that business. I mean, we've recently made an acquisition into the fund sort of space, so we can also grow funds under management there off balance sheet if you'd like. And our Eastern European business is in a solid market. I mean, Poland, other than Australia, those two economies have probably been the best performing economies on the planet over the past 10 years. And we'll probably remain focused there and try and expand that business. And then the UK at this stage, we're fixing the balance sheet of that business, and I think positioning it for growth going forward. But I don't think in the short term, probably, look, we are opportunistic and always have been, but in the short term, probably it's unlikely that we'll be targeting other jurisdictions for now.
Yeah.
Estienne, thanks so much. First one from me, and I've got lots of questions that have come into the DMs, which is lovely. That's what we want to see. So the first one's a bit of a macro question, and it is, how do you see the global inflationary environment influencing Growthpoint? Obviously, you've got this, wide, diversified portfolio, so perhaps a bit difficult to answer, but, do you see bigger impacts in certain geographies? Like, what's top of mind for you guys when you think about where we are at the moment in this inflationary cycle?
Yeah. So I'm going to go with the typical answer economist goes, one hand and the other hand. So they're very balanced characters, the economists. But so on the one hand, the negative hand, what we've got is obviously increasing interest rates. Okay, and that environment clearly, typically for yield investments have been, reasonably negative, and the increase in the costs and inflation has a negative impact on the business broadly speaking, and that will be in all jurisdictions. On the development side, interestingly enough, there we are a little double-minded, so it fits somewhere between the hands, because yes, it costs more to develop, let's say, new industrial warehouses. In fact, significantly more to build new offices and industrial and retail facilities. But the upside of that marked increase is that your existing portfolio becomes more valuable, and your ability to charge better rent in an inflationary environment is also improved. So what we are seeing is actually, certainly in the industrial space, where the dynamics are quite good from a demand perspective, is that there's quite a gap opened up between new rental for new boxes relative to, let's call it, existing facilities. So that will flush through into the portfolio in the South African context. What we are seeing in the international context is also where, they had very, very negative inflationary sort of environment. All of a sudden, now their rentals often are linked to CPI, and that CPI is circa 8 to 9% depending on the jurisdiction. And we're starting to see rental growth fundamentally come through on existing leases, which is the first we've seen in since we've been invested in those markets. So that'll be a positive for Growthpoint, and I think that will be the positive side or the positive hand. So as you can see, there are negatives and positives. Ultimately, the way we have structured our balance sheet will position us well for an increasing interest rate environment, in that, predominantly 80% of our debt is hedged in the South African context. Those interest rates roll off over 3.5 odd years. As such, the impact of high interest rates will be hopefully slower. I think also the sort of market impression is that those interest rates will probably contract a little bit quicker than is expected. And certainly in the South African context, if we go and look at what the Reserve Bank has been doing, is moving up the interest rates now in line with effectively the US, and that's really to protect the rand and to avoid sort of secondary inflation. So yes, I think that you'll find that that will probably contract also a little bit quicker as soon as the sort of US tops out.
And then just quickly, I might just add on that the interest rate, in Australia today, they had the Reserve Bank raising rates there, but they only went 25 basis points instead of what the market was expecting, 50. And the kind of rhetoric around what they were saying was, we've had a lot of uptick in interest rates. We're going to maybe not so much pause, but we're definitely waiting to see the impacts of it. So yeah, in terms of interest rate cycles, it was interesting that Australia kind of booked a trend today. Another question for me is,
stock as a result upped like just short of 10% just today as a result.
I mean, the whole market was up nearly just a tad under 4%. So it was a good day for Australia. But I just wanted to talk about, I mean, with the business that you have, where you've got, REITs, and then, this burgeoning funds management business in various guises, do other property niches start to come on your radar? Like data centers, retirement villages. Is that something you're thinking about, or is it, focusing on building out the healthcare business, building out the broader Africa business? Just kind of some context around that.
Yeah, so Mark, ultimately the other, let's call it niches, as you've referred to, will really depend on the demand from the investors. And we are thinking of other products. So the idea is to simultaneously build the existing funds under management. So increase the healthcare, increase student accommodation, grow the Lango, the Africa business out, while we develop new product, if you'd like, for the institutional investment market. And we did allude to potentially looking at a sort of a telecommunications infrastructure product that we can, that we might bring to market, depending on, if a couple of things fall in place for us. And we are testing, with the institutions if there's demand for that specific sort of real estate exposure. Now, just to appreciate, these funds typically are that it's the real estate, right? So not the healthcare operation. So our clients in the healthcare space would be typically Netcare or Mediclinic or Busamed, so the operators. And this in the student accommodation sort of side, we've got there the students, and often the universities are the clients of those funds. And if you go into these other niches, obviously it's always important to understand who's paying the rental and what the investment case is for each one of those sectors. But the interesting thing is that globally we've seen a massive increase in niche investing in the real estate space, and I foresee that Growthpoint's really the only material real estate fund manager in the country. And we are educating the market a little bit. If you go to Australia, let's say a Goodman or a Dexus, any of these big REITs probably have as much assets off balance sheet, if you'd like, in funds than they have on their balance sheet. So that is obviously an ambition for us, is to grow that part of the business quite significantly, and it will include other products if you'd like.
Estienne, I'm going to start trying to combine some questions so we can try and get through them as best. So for those who have asked questions, you might hear pieces of yours and a piece of someone else's that comes through. So just on the South African portfolio, so obviously load shedding is top of mind. So there's a question around, what is the impact on CapEx on properties to adapt and deal with load shedding? And then there's another question that is kind of linked, which is around the structuring of South African leases, for inflationary pressures, I suppose, because electricity is obviously a big one in that. To what extent can you recoup those sort of costs through the leases? What is load shedding costing you? Just some stuff around that. I would ask you for color around that, but people know I hate that. So I'll ask you for some stuff around that instead.
No, stuff's good. So the reality is we've, Growthpoint has, before the word ESG became the flavor of the month with all the asset managers, we have already invested over many years, over 10 years, into optimizing our real estate to effectively make the operating cost as low as possible. So that included rolling out solar, which at that time was pretty limited in terms of what we could do per property, and then looking at water and waste and all those other aspects. So we have prepared our portfolio for what is playing out to some extent now. What we have also undertaken is we intend to double our capacity from a solar perspective in this current year. And the reason is obviously the regulatory levels have been lifted from a generation perspective, and that is an investment opportunity in itself. So we are looking so from a CapEx perspective, we're going to be spending over 100 million on solar, but that's going to give us between 70 to 35% return, or 30% return. So as a range, depending on whether it's in a municipality or within an Eskom area. So that's on the one hand. I think in terms of load shedding, the issue is pretty much operational, making sure that all the generators are full and that the buildings have sufficient power and services. The structure of our leases provide that we recover electricity and utilities from our tenants. And in fact, in the way it's structured, we buy wholesale and we sell retail. So there is a bit of a margin in that, albeit that margin has shrunk significantly over the years. But nevertheless, the idea is always to provide our clients with the best possible service and the best facilities. And increasingly, we are playing the role of the municipality, albeit that we pay rates and taxes and for services that we're increasingly not receiving. So it is an area that the real estate sector is focusing on quite carefully, and we are looking to see whether increasingly we can maybe claw back some of those losses to the municipalities over time.
I got two questions. One is just a quick follow-on from that load shedding question. And the question is, what impact does it have on kind of turnover rents and footfall into the say like the V&A Waterfront, I even know myself, okay, we've got load shedding, okay, let's make a plan for dinner, and then you end up going out for dinner, or rather than like kind of like staying at home, or it's like, oh no, it's now 4 hours this afternoon, okay, I'm going to bring the kids to the aquarium down at the waterfront. So is there, now that we've had it for a couple of weeks, has there been a noticeable trend in footfall changes, or retailers feeding back to you?
Yeah. So, I mean, I think firstly is to understand that, most of our facilities do have some form of backup. I mean, there's over 46 generators running at the V&A at Winnie. And I mean, you guys in the Cape live the dream. There's no doubt about it. You can go to the V&A at any time of day, and there's power and there's water, and pretty much everything's working beautifully. So that certainly remains a very reliable facility for people to go to. But even the rest of the portfolio, it does vary. It'll depend on if the underlying tenants or the clients are prepared to pay for some of that backup power. So it is property dependent to a large extent. But what we have seen is that on average, the trade in our shopping centers, we haven't obviously had feedback now in stage 6 and 7. It's still pretty early days there, but I'm sure we'll be able to give the market some feedback maybe over December as to how that has impacted. But certainly what we have seen is sort of systematic improvement in trade through these facilities. But there's no doubt they will be impacted, and there is a cost that is a factor for us in this process. Just the logistics, you can imagine, of keeping all these generators full.
Yeah. And then the second question was, you mentioned the buyback happening in Growthpoint Australia, the REIT there, and one around, when does a buyback potentially come into the capital management policy of the Growthpoint South Africa REIT?
Yeah. So look, I mean, it is a hotly debated topic. You can imagine at a roughly, 11.5 to 12% forward, it's probably the best investment we can make. I think, given our stated objective of ensuring a very conservatively structured balance sheet, I think the inclination, and probably at this stage, is to probably be a little bit more conservative. But, the world's very dynamic, and in the end of the day, if this very deep discount continues, it'll be in our best interest probably to mop up some of the free float there.
Yeah, let the ghost jump back in here. I've had
Yeah.
a few questions.
Yeah, I've got lots here. So this is only because someone asked me to add the color purple, so now I'll go with it. The question is,
our purple is actually midnight cherry, is the official color.
Mine is unnamed. Mine is ghost purple, but we'll go with it. So the question is, can you get your escalation and reversion trends back to pre-pandemic levels in retail specifically? Do you believe you can get back there? And the comment made in the question is, obviously, office is a completely different story. So yes, I think we can all bank that. So this is specifically around retail.
Perfect. So the retail, quick answer to that is, it's all dependent on the actual trade, that trading density number, because the rental you can charge any specific retailer depends on how they're trading in that footprint or how that shopping center is trading. So it is very much a shop by shop, property by property sort of scenario. But yes, I'm reasonably confident that, given the inflationary pressures, that, the trading densities will be going up, and ultimately it will support higher rental levels. And given the high inflationary environment, the CPI number is usually used against the landlord, okay? But now the foot has changed a little bit, and I think that hopefully we'll be able to use the same argument on those very same retailers.
Got another question here. Sorry, Mark, if you don't mind. It's a bit of a cheeky one, but you've got to take at least one cheeky one today, surely. So the question is around the value in scale. And Growthpoint is absolutely enormous. Obviously, it's by a country mile the biggest company we've had on Unlock the Stock. It's an absolute monster. In the property industry, what is the value in scale as opposed to smaller, sector competitors, I suppose, and the sort of performance that they are delivering?
Yeah. So I think the environment, I think investors have to appreciate that most international investors globally have probably more outflows at the moment than they're having inflows. And as a result, you know, the bigger you are, probably the more exposed you are. So if you, you know, the emerging markets are risk off, so the American investors are pulling their cash back. So that has a depressing impact on our share price, but it is as a result of our liquidity. And should that demand change, which it's very volatile and fickle. You know, I believe that the market isn't pricing the quality of the stock or the liquidity value or its tradability at all. At this stage, it's just saying we need some money back. It's the most tradable and liquid investment. We'll sell there first and then sort out the balance of the real estate stocks. And in fact, it probably bodes true for all the Aussie 40 counters at this stage. They remain under pressure. But as I said, you know, that market, if the interest rate environment has a different, let's say, forward view, I think it'll change pretty quickly, and you might find that discount that you see gets wiped out. And if we can deliver growth, you know, you'll start seeing potentially even a premium to NAV come back.
Mark, can I sneak in with one more? And then it's back to you, I promise. Because it's also a cheeky question. Got to do two cheeky ones in a row. So this is the cheekiest one of all. So recognizing that obviously the share is trading at a big discount to NAV, and I think you've mentioned it's a great investment. So the cheeky question is the management team at Growthpoint putting their money where their mouths are? Are you investing in the stock? You know, just a question around, I suppose, ultimately alignment.
Yeah, so well timed. I had to exercise some options. I bought them in. So we are investing. I am an investor. I'm an investor in Globalworth, GOZ, and Capital and Regional, as well as Growthpoint, for obvious reasons. And I must honestly say, you know, if you can get a 12% forward, roughly, you know, depending on how we go this year, you know, I think it's a very decent investment, and it's the sort of investment you can put in the bottom drawer, forget about it, and when you open your eyes in 10 years' time, I think you'd be very grateful that you made the investment.
Estienne, maybe I can just add to that we actually do have minimum shareholding requirements in terms of our remuneration structure, and Norbert is sitting at over 500% of his total fixed remuneration in shares. Estienne's over 800%, and Gerald, our FD, is at 100%. So certainly Norbert and Estienne are way above their minimum shareholding requirements.
Thanks, Lauren. Yeah, minimum shareholding requirement, not something we see often in the South African market, definitely a lot more prolific in the US market. And yeah, for Rob thinks Growthpoint big, you should look at Prologis in the US market if he wants to see a big REIT, or American Tower, or Simon Property Group.
Yeah. Unfortunately, if you divide anything into the dollar, it does make, you know, interestingly enough, if you compare the scale in terms of GLA and, you know, the size of the portfolio, it's quite comparable to many of these US investments. But if you look at the dollar values, we've been obviously marked down quite a lot.
Then the final, I think, question, because we are starting to push up on time. As big as the V&A Waterfront is, and you know the size of the whole site, there's still an undeveloped portion of it. It like still has stuff to go. So can you just maybe talk about how much still needs to be developed, and has the development mix changed now post-COVID? You know, before COVID, you were thinking, okay, we've got this last section to do. This is what we're going to put on there. COVID happened. You know, has timelines changed, mix changed, and you know, what else can people expect to see down at the waterfront if we look out, you know, 5 years from today?
Sure. So just to give you a context, I think when we acquired the V&A, it had 603,000 square meters of bulk rights. of which roughly about 380 was developed. That number sits now over just under 470, okay, which is developed, leaving us just short of 100 odd, 130 odd still to develop, right? What we are busy looking at, so the biggest component of development rights is at the Granger Bay. So that's where the Grand is, on the other side of the shopping center towards the sea. Between the Radisson and the shopping center. And what we're planning quite a significant expansion development, which will require additional rights. So what we will be probably doing is applying to the municipality for additional rights at the V&A. And you know, if you look, let's say 20 years forward, because this is a sort of the kind of timelines we're working at, what you will see is a incredible marina area which will be added, additional hotels, even a resort potentially. You know, it will be a facility that will give the Cape Town and tourist community access to the sea, okay, which is quite unique. If you think about the V&A, it's all sort of faces into the harbor, not out to the sea. So it'll give people a better interaction, which is quite a difficult environment, certainly in the winter. So you're talking about additional shore protection, you know, and some very inexpensive infrastructure that will be going in over the next 20 years, and very much mixed use and providing accommodation and facilities for all LSM levels in the population, you know. So that's certainly the way we think about it. It is every South African's asset, so it's not just ours, and everybody should have access to that asset. And as such, you know, the sort of things that we're looking to introduce will be adding value ultimately to that proposition and vision.
Thanks, Estienne. I think we leave it there because we are pushing up on the hour, and I want to be respectful of your time, given the size of the business. I'm sure you're a busy man. So I'll just hand back to Vanessa to wrap up today's session.
Thank you so much to everyone who participated in Unlock the Stock today, and a special thank you to Estienne and to Lauren for making the time to talk to the retail investors. We hope that you've enjoyed the event, and as a reminder, it will be on the Keyter Rech Investor Solutions YouTube channel if you want to take another listen. And please join us for the next session, which you can see on your screen, which is Thursday, the 22nd of October, where we'll be talking to Pan-African Resources and Calgro M3. Thank you, everyone. Goodbye.